Good evening, everyone. It's December 21st, 2025, and I'm your host, a 10-year veteran of the crypto markets. The market has just served us up a nasty pre-Christmas surprise. Just today, we witnessed an extremely alarming data point. Bitcoin ETFs saw another massive net outflow of $158 million. This marks the second consecutive day of nine-figure capital flight. Friends, this isn't just retail panic selling anymore. This is Wall Street's smart money, the institutions managing billions who are now voting with their feet and structurally de-risking their positions. What danger signals are they seeing? In today's video, we'll use data and logic to peel back the layers, to deeply analyze the market signals hidden beneath the surface, and most importantly, how we should deploy our trading strategies over the next 24 hours. Data-driven evidence. First, let's look at macro sentiment. As you can see, the latest fear and greed index is at 28, firmly in fear territory. While this number hasn't changed much from yesterday's 27, this stability itself is telling. It signifies that the market's cautious sentiment has solidified, with no signs of improvement. There's a pervasive sense of hesitation and uncertainty in the air. Bulls lack the conviction to enter, while bears are waiting for a better opportunity to strike. This persistent state of fear sets a bearish undertone for the rest of our analysis. Second, and this is our core piece of evidence today, capital flows. As I mentioned at the top, ETFs have bled over $150 million for 2 days straight. From a macroeconomic perspective, this could reflect institutional investors' year-end asset reallocation or a pessimistic outlook for the first quarter of 2026. This is not a short-term blip, it's a structural bearish indicator. But what's even more terrifying? A double exodus. We're not just seeing institutional funds leaving. Our on-chain data tracking shows that exchanges are also experiencing a net outflow of funds. This double whammy of both ETF and on-chain capital flight is historically rare and points to a very ominous conclusion. Capital is fleeing the crypto ecosystem. This isn't simple profit-taking, it's a fundamental shakeup in short-term market confidence. Third, let's apply the Wyckoff method to analyze the current price action and key levels. Right now, the price is being tightly compressed within a very narrow range, between $87,000 and $90,000. In Wyckoff theory, this is a classic accumulation or distribution phase. So, which one is it? Combined with the capital flow data we just reviewed, the answer becomes quite clear. This looks much more like a high-level distribution range. Look at the order book heat map on the screen. There's a significant bid wall around the $88,000 level providing support, which misleads many into thinking this is the bottom, luring them in to provide exit liquidity. But this is likely a demand absorption trap set by market makers to stabilize the price while they offload their bags at higher levels. The real battleground is at $90,000. You can see a monumental sell wall stacked up here. This isn't just technical resistance. This is where smart money is stealthily distributing their holdings. A large number of long positions also have their take-profit targets set at this psychological level. Every time the price touches this point, it's like hitting a brick wall. The price has now fully returned to its value area. Wyckoff teaches us that when price tests a narrow range repeatedly, while capital is consistently flowing out, it's typically preparing for the next leg down. The whales are using this range to sell their holdings at a high price to investors who are FOMOing in. Fourth, let's zoom out to a higher time frame and look at the long-term trend on the weekly chart. Take a look at this weekly chart. The MACD indicator has already flashed a definitive long-term bearish signal. The MACD and signal lines are trending below the zero line and are showing a clear bearish crossover with a downward slope. What does this mean? It means the market's long-term momentum has officially shifted from bullish to bearish. This isn't just a 1 or 2 day pullback, it's a trend signal that could persist for weeks or even months. For long-term holders, This is absolutely not a good time to be adding to your position. The next major structural support level we need to watch is around $80,000. Strategic conclusion. All right, let's synthesize all the evidence. Macro sentiment is in fear, we have a dual exodus of institutional and on-chain capital, price is suppressed within a $90,000 distribution range, and the weekly trend is bearish. All the clues are pointing in the same direction. So, what is our actionable game plan for the next 24 hours? First, based on the MACD indicator, upside momentum on the daily timeframe is exhausted, and the weekly timeframe is dominated by bears. Therefore, any rally into the heavy resistance zone at $90,000 should be seen as a potential shorting opportunity, not a signal to go long. Second, let's bring in the ATR, Average True Range, indicator for precise risk management. The current daily ATR value is around 2,000 points. This means the market's average daily fluctuation is about $2,000. Therefore, here are my specific recommendations. For bears, if you plan to short near the $90,000 resistance, your stop loss should be placed at least one ATR unit above it at $92,000. This will help you avoid getting wicked out by market noise and stop hunts. Your first take-profit target can be the support zone at $87,000. If the price breaks down below that level with significant volume, the next target is $85,000. For bulls, I must stress this again. Do not open new long positions near the massive sell wall at $90,000. That would be like trying to stop a freight train. If you are already in a long position, it is crucial to set your stop loss just below the key liquidity zone of $87,000, say at $86,500, to protect yourself from a liquidity sweep. If there is a confirmed breakdown below $87,000, you should exit your position without hesitation and wait on the sidelines. The anchor returns to a full-screen shot in the studio with a serious and sincere tone. The market will be filled with extreme uncertainty in the short term, and in this environment, risk management is always priority number one. Remember what I always say, before the trend becomes clear, protecting your capital is far more important than chasing profits. All right, that's all for today's deep dive. If you feel my data-driven analysis has helped you see the market more clearly, please be sure to smash that like button, subscribe, and hit the notification bell so you won't miss our next critical market update. Finally, I want to hear from you in the comments. Do you think the price will break out above the $90,000 distribution range, or will it break down below the $87,000 support? Leave your thoughts below. Thank you for watching, and I'll see you in the next video.